Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Mastercard Incorporated, ticker symbol MA. So Mastercard is a business that is much loved by value investors far and wide. It is a major position in Chuck Akre's Akre Capital Management. Guy Spear also holds Mastercard as a significant percentage of his Aquamarine Capital portfolio. Mastercard is also owned by Thomas Russo, Tom Gaynor at Markel, and it's also a part of the Berkshire Hathaway public stock portfolio. There are a lot of esteemed value investors who are invested into Mastercard, as it alongside Visa really make up some of the payment rails for a lot of the world's credit and debit card payments. Currently, Mastercard is trading for $333.19 per share. Over the past year, their stock price is pretty much flat. They're down just a little under 1%. Over 5 years, a totally different story for Mastercard. Their stock price is compounded at a rate of over 17%. Over 10 years, they're compounding at a rate of about 22%. And going back prior to the global financial crisis, over nearly the last 17 years, Mastercard has compounded at a rate of 30% annually. So this is just an absolutely phenomenal return here. From their public offering, Mastercard is up more than 73 times over this time frame. In addition to the stock price returns, Mastercard is also paying out a small dividend of approximately 0.6% yield right now. So adding in that dividend, over this time, Mastercard has returned over 30% annually for shareholders. Mastercard is currently trading between their 52-week high and their 52-week low. They are a very large business. They have a $315 billion market cap. So for additional background about the company, Mastercard is the second largest payment processor in the world, having processed close to $6 trillion in purchase transactions during 2021. Mastercard operates in over 200 countries and processes transactions in over 150 currencies. The company offers payment solutions and services under the Mastercard, Maestro, and Cirrus brands. Mastercard Incorporated was founded in 1966 and is headquartered in Purchase, New York. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Mastercard based off of their business fundamentals. So this analysis is still an evolving process. It will continue to improve and get better over time. So it's a work in progress as well as an opportunity to learn in public. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are 2 reasons for this. The first is that over the long run, over the course of decades, a stock is going to return approximately what its underlying business returns. And the second is that the average publicly listed business earns about a 7% return on capital. So by asking for average returns that are 14% or higher, we can potentially build in some margin of safety for ourselves here, based off the overall quality of the business being about twice as good as average. Mastercard is blowing all of these metrics out of the water. The lowest return on capital that they had over this time came in at over 40% in 2020. Currently, over their last 12 months, Mastercard is producing 58% returns on capital, and averaged out over this time, they're earning 56% returns on capital, which is 8 times better than that of an average business and 4 times better than the metric we're looking for. This is a massive check to start off on metric number 1. Metric number 2, here we're taking a high-level overview of the cash coming into the business. We want their revenues, earnings, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. Over this time, Mastercard has increased their revenues by more than 70%. Their earnings have more than doubled, and their free cash flows, including their last 12 months of numbers, have just about doubled over this time as well. So all 3 of these are up with very strong growth across all 3 metrics. This is another very strong sign to see here for Mastercard and another check on metric number 2. Metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Mastercard on a per share basis. Specifically, we're looking for earnings per share growth over the last 5 years. So as we learned in the previous metric, Mastercard has more than doubled their earnings over this time. Additionally, we're seeing here that their earnings per share are up at a rate that's slightly faster than this. And this is because earnings are only the numerator in this equation, with their shares outstanding being their denominator. So Mastercard has both increased their numerator and decreased their denominator. On a per share basis, they've experienced very strong earnings growth. Additionally, because they've repurchased about 9% of their shares outstanding over this time. So this is great as a long-term shareholder in the business, because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that company. And when a business buys back stock by decreasing the number of shares that they have outstanding, they're actually increasing your ownership percentage in the business, which is ultimately going to increase the percentage of the business's profits that you're entitled to. Not only has Mastercard increased their profits over the last 5 years, if you've been a long-term shareholder in the business, they've also increased your percentage of those profits as well. So this is very strong earnings per share growth to see here on metric number 3, and this is our third check in a row, perfect through our first 3 metrics to start off for Mastercard. Metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the last 5 years. Again, their free cash flows have just about doubled over this time, and with those 9% buybacks, their free cash flows per share have grown at a rate that's even faster than that. This is another check on metric number 4, as their free cash flows per share have more than doubled over the last 5 years. Additionally, another sign we're looking for here is that over extended periods of time, typically meaning 10 or more years, we'd ideally want to see a business's earnings and free cash flows be roughly the same. And even though 5 years is only half of that time frame, that's pretty much what we're seeing here from Mastercard. So that's potentially indicative that they have strong quality accounting in their business. Now, this is only one such data point that would potentially indicate that, but it is nice to see here as well. We are still perfect through our first 4 metrics, 4 checks, and no X's so far. Next up for metric number 5, here we're evaluating how the company is utilizing leverage. So we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of potentially poor outcomes. So we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that Mastercard has produced over the past 5 years. Currently, Mastercard has about the same amount of net debt that they ended last year with approximately $6.1 billion in net debt. And Mastercard is very strongly cash flow generative. So in 3 out of these 5 years, with only 1 year's worth of free cash flow, they would have been able to more than pay off all of their net debt. Over this time, Mastercard has produced more than $35 billion of free cash flow. So based on the company's use of leverage, it looks like the company is very slightly levered at best. They're using seemingly very appropriate amounts of leverage in their business, and Mastercard looks like it would be in a strong, not overly levered financial position here. This is another check on metric number 5, and we are perfect 5 for 5 so far. Our 6th and final metric, the big metric of them all, we want their average free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the rate of the 10-year treasury and give us another reason to potentially be interested in Mastercard. So we're using their total enterprise value here rather than their market cap, because total enterprise value is going to give us a better picture of the business that's a little closer to economic reality by taking into account both their market cap and their net debt position. So it's going to be more similar to as if Mastercard were a private company. Currently, Mastercard has about a $322 billion total enterprise value, and we learned that over the past 5 years, Mastercard has produced $35 billion of free cash flow, meaning that in an average year, Mastercard is producing $7 billion of free cash flow. So when we divide their $7 billion of their average free cash flow by their $322 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of only 2.2%. That's just above half of the yield of the 10-year treasury rate right now, and that's less than half of the 5% yield we were looking for. So on an average historical basis, Mastercard does not look like it's giving us the adequate risk premium that we were seeking from the company compared to its enterprise value, and so this is going to be our first and only X on metric number 6 today. Worth being aware of as well is that over their last 12 months, Mastercard has actually produced quite a bit more free cash flow than what they've been producing on average over the last 5 years. So Mastercard has produced about $10.9 billion of last 12 months of free cash flow. So to get a current free cash flow to enterprise value yield for the company, when we divide their approximately $10.9 billion of their last 12 months of free cash flow by their $322 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of about 3.4%. So while that is closer to the yield of the 10-year treasury, and that's better than where they've been at historically, that's still going to be below that yield. And so even though the economic reality of the business is probably somewhere between their average and their current yields, they're still both below where we would ideally want them to be at. Again, keep in mind that this is only one data point here when you're looking at Mastercard. So it's not necessarily a make or break for the business. Sure. Then here we're looking at Mastercard's dividend profile. So Mastercard often has the reputation of a dividend growth stock. Currently, they're paying out a modest dividend yield of only 0.6%. However, over the last 5 years, they have steadily increased their dividends per share, nearly doubling it over this time. And in all 5 of these years, Mastercard has more than thoroughly supported their dividends with their cash flows. Currently, they're paying out less than 25% of their cash flows as dividends, and as the company is not overly levered, they've got a lot of potential use for their cash flows. It seems here like Mastercard would likely be able to continue growing their dividend for a long while to come into the future, assuming, of course, their free cash flows remain steady and that the financial positioning of the business does not materially change. Then finally here we're using a discounted cash flow model to come to a potential fair value for Mastercard. So starting with their current free cash flows per share, and then projecting these out over the future based off of historical assumptions for Mastercard's abilities to grow their free cash flows over the past 20 years. So these are assumptions that you need to confirm or disconfirm for yourself whether or not these are going to be potentially applicable to get a baseline projected estimate for Mastercard going forward into the future. So assuming a growth stage over the next 10 years where Mastercard grows their current free cash flows at a rate of 14% annually, and then assuming a terminal stage for the 10 years out after that, so projecting 20 years out into the future in total, where Mastercard's growth rate is cut in half and they only grow their free cash flows at a rate of 7% annually. We're not going to be including their tangible book value because that is skewed based off of how accounting is done for Mastercard's buybacks, and Mastercard has repurchased quite a number of their shares over time. So if we were looking for a 10% rate of return going forward over the next 20 years for Mastercard, then based off their historical abilities to grow their free cash flows, it looks like a fair value for the business would be approximately $259 per share. Again, using these same historical growth assumptions, it looks like from today's valuations, you'd be reasonably able to expect about a 7.5% rate of return going forward from Mastercard. Keep in mind that this would be including these dividends. Also, please be aware that this is based off of these assumptions, which you need to do your own homework on to determine whether or not these are really going to be appropriate as inputs here for this discounted cash flow model for Mastercard. A discounted cash flow model, just like any other model across any discipline, is going to be highly subjective to the inputs that you put into that model. So likely, if you're putting in garbage, you're going to get garbage out. Also, please be aware that this type of analysis is not financial advice. It is not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, Mastercard checks the box on 5 out of 6 metrics. They're earning extraordinary returns on capital, averaging returns that are 8 times better than that of a typical business. They've experienced very strong revenues, earnings, and free cash flow growth over the last 5 years, and they've repurchased about 9% of their shares outstanding. So they've had very strong per share growth as well. This per share growth, coupled with their very high returns on capital, is really one indication of potentially being a wonderful business, as it compounds the intrinsic value of the business at a very fast rate. Additionally, Mastercard is using only very modest amounts of leverage at best. They're very highly cash flow generative relative to the debt that they're employing in their business. Our only X came on the business today when we were looking at their free cash flows, comparing those to their enterprise value. So both on a current and a historical average basis, Mastercard did not give us the yield that we were looking for in comparison to the 10-year treasury to potentially give us an adequate risk premium for the business. So based off of that metric, it doesn't look like there's too much of a margin of safety in the company. Then taking a look at their dividend profile, Mastercard is paying out their dividends very conservatively. They're bringing in plenty of cash relative to their dividends that they're paying out, and it looks like Mastercard's reputation as a potential dividend growth stock for the future would likely be able to extend far into the future. Then finally, performing a discounted cash flow analysis of Mastercard based off of their historical abilities to grow their free cash flows over the past 20 years, which are assumptions that you need to do your own homework on to determine whether or not those are really applicable going forward for Mastercard. Then it looked like from today's valuations, you could potentially expect about a 7.5% rate of return going forward into the future on Mastercard. And if you were looking for a potential 10% rate of return, that you'd have to wait for their share price to decline closer to where it was back in spring of 2020. Again, you need to do your own homework here to determine if that's really going to be applicable and really going to be the case for Mastercard going forward. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. Investing does bring with it the very real risk of permanent loss of capital. So you really want to know what you're getting yourself into. This analysis instead serves as a beginning and holistic understanding of Mastercard as a business to help you determine if it's worth your time and energy to dig in and learn more about the company. So if you're interested in learning more about Mastercard, I'd recommend checking out write-ups of the business. You can either do so on the Value Investors Club, or you can look at a paid service such as Seeking Alpha. I've used Seeking Alpha myself, and I have an affiliate code with them. If you're interested in checking that out, I have a link in the description for a 14-day free premium trial. That will also give you a nice chunk of change off of a paid Seeking Alpha subscription as well. So checking that out will directly support the channel, and they've got a lot of good stuff. Additionally, if you're interested in Mastercard, it's also worth your time to dig into the filings for the business so you can read through their historical 10Ks and get a better sense of the history and the operating results of Mastercard. Management will also lay out some of the potential risks that the company faces and give you a better understanding of both the environment that the company operates in and what their strategic decision-making approach is going forward into the future so that you can evaluate management when it comes to things such as their integrity and their competence, especially related to capital allocation. When you're finished with those phases of your research, I'd also recommend reading through their 10Qs as well as reading through some of their proxy statements so you can get a better understanding of the incentives that management are under. Additionally, after all of that work, if you're still hungry to learn more about Mastercard, you can also read through some of their recent quarterly earnings call transcripts, where some of the Q&A questions that analysts ask management may be especially interesting as the business navigates a potentially tumultuous time. So through this deeper research, as a value investor, you're ultimately trying to understand the business as if you're going to own 100% of it, and you can truly understand the underlying essence of the company and understand what's important and what's not important for Mastercard going forward. As you learn more about the business, you'll get a deeper sense of both the quantitative and qualitative aspects of the company, which will help you determine for yourself what a potentially appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of Mastercard Incorporated, ticker symbol MA. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Mastercard with me today, and have a great day.